Hello, everyone, and welcome to the Represented series. I'm extremely excited to bring in our next guest who is going to educate you on the importance of kind of managing through a financial crisis, which is really what we're in the middle of now, unfortunately, as we're all home dealing with COVID and really trying to wrap our head around our financials and how we're tackling that, right? I know a lot of us have either, been furloughed or had issues with our jobs or having to figure out how to work from home, possibly with kids in the household too, rethinking our livelihoods, reimagining our budgets in the way that we work when it comes to our finances. So I'm excited to soon bring on Tamara Hastings, who is a financial advisor with Eagle Strategies. And I'm going to read a little bit more about her bio so that you can learn more about her. She has over 30 years of experience in accounting and financial services industry and as a business owner. Tamara has been entrusted by her clients to help them build and preserve their wealth and plan towards their financial well-being. She is currently a financial services professional with NYLIFE Securities LLC, a registered broker-dealer and licensed insurance agent with NYLIFE Insurance Company in Bethesda, Maryland, specializing in retirement planning. She provides fee-based financial planning, investment advisory services, and access to third-party investment management programs through Eagle Strategies LLC. Eagle Strategies LLC is a registered investment advisor. Both Eagle Strategies and NYLIFE Securities are wholly owned subsidiaries of NYLIFE Insurance Company. Tamara graduated from Rutgers College School of Business, so go Rutgers. I'm also from the state of New Jersey, so proud to hear that as well. With a Bachelor's of Science degree in accounting, she also obtained her Master's of Science in Taxation from Baruch College, the City University of New York. Tamara previously practiced as a CPA at prestigious CPA firms, Ernst and Young in New York City, and EisnerAmper in New Jersey, and Dixon, Hughes, Goodman, and Tyson Corner, Virginia. She has extensive experience serving closely held family-owned businesses and guiding high net worth individuals on tax savings and financial strategies. Tamara worked at Merrill Lynch for 10 years as a certified financial manager and financial advisor. While working at Merrill Lynch, she appeared on WABC Channel 7, Their Money Talk, Good Morning America, and Fox Channel 5, Good Day New York, discussing tax saving strategies for high net worth clients. So I'm extremely excited to bring Tamara in. How are you?
I am doing fantastic. How are you doing today, Dana?
I'm doing well. It's a pleasure to have you on, and we are so excited for all of the lovely information that you're going to give all of our viewers and really giving everyone the ability to just kind of refocus in how they're managing their finances.
Yes, thanks so much for having me, Dana. It's truly an honor to be here with you today and just share some information to educate our people about our finances and how to be on top and in control of them.
Absolutely, which is extremely important all the time, but I feel like now so more than ever. And Tamara, I always start off the Represented series, which is really important to myself and, of course, our team here at CHIP. And why we started this series was to bring more visibility to financial professionals of color, specifically Black and Latinx. How does it feel to be a financial professional of color right now with everything that's going on in the world?
I can honestly say I'm truly blessed to be an advisor now. I feel like people really realize the value that we can bring. My why is I grew up loving the financial world, practiced as a CPA, and realized that I wanted to bring more comprehensive planning to my clients. And this is a great way, a platform to be able to share information and to do that.
Awesome. Well, again, we're so happy to hear you. So I am going to step out of your way and really let everyone understand why you're here and all the important gems that you're going to be dropping. So I'm hoping everyone ends up taking a lot of notes.
Awesome. Thank you so much. I'm going to hopefully get this presentation up. Okay, so this evening, I am going to talk about financial wellness and how to be resilient during a crisis. this is really an opportune time to talk about these things. So stress levels, I found, are the same across all income groups, right? 90% of Americans feel anxious about money due to the COVID-19 pandemic. Unfortunately, financially stressed people are more likely to face physical and mental health challenges. So here are some of the effects. This is the sources from the National Endowment of Financial Education via CNBC. And it talks about the different levels of stress. This is going back to the 2008 financial crisis, where, as you can see, the red represents a high level of stress, and then the darker, I guess, blue is a low level. So people have found that they've had stress with back and muscle tension. That's about 50% of people. Ulcers and digestive issues, that's about 20, close to 30%. Heart arrhythmic issues, it's about a little less than 5% or over 5%. High blood pressure, a little over 30%. Severe depression, migraines, severe anxiety, and insomnia. So regardless, like I said, of the 90 people that have been interviewed, 90% of Americans feel anxious about their money. So don't feel like you're alone. All right, so here's a current snapshot. Financial health is the degree to which people are able to be resilient and take advantage of opportunities over time. And it rests on 8 indicators. So first one is you should save less, spend less than your income, right? So save more and spend less. The second thing is to pay bills on time, because that affects your credit. So when you're late, it impacts your credit and your credit scores and your abilities to purchase. Number 3, have sufficient liquid savings. So if there is an emergency and you need to tap into assets, have those assets liquid. I would say at least 3 to 6 months. So if you need to tap into monies, you can do that and not have to borrow money at high interest rates and having to pay those back. So this would help you with your flexibility. Number 4, have sufficient long-term savings. So this is saving for the future, such as retirement, looking at those assets and making sure they are properly diversified. So what that means is not having all of your eggs in one basket and making sure that those assets are growing for the future. Number 5, have manageable debt. So you can try to eliminate having to borrow money. Number 6, have a prime credit score. Number 7, have appropriate insurance. That's going to be important, being able to protect your assets. So if something were to happen to you, or if you're married, your spouse, having insurance to replace income that may no longer be coming into the household, should in case something happens to one of the breadwinners of the household. And then last but not least, number 8, plan ahead financially. So people don't plan to fail. They just fail to plan. So when you plan ahead, when these financial things happen, you're more financially aware. All right. So individuals fall along a spectrum of financial health. In the US, only 28% of people were considered to be financially healthy in a 2019 survey. So if you look at this survey, those percentages, so from 0 to 39%, they felt financially vulnerable. This is their scores. So you could see the percentages. From 40 to 79 felt that they were financially coping, right? So those that got a score of those between 40 and 79. Those that received a score between 80 and 100, they felt financially healthy. So that's what, about 28%. So that's really low. So we want to work on, because financial wealth and health, they go hand in hand. So finances have become more complicated over time. Many Americans are already facing challenging circumstances prior to the pandemic. But as you can see from this chart, I know it's a little busy, But these percentages along the left-hand side is the percentage of private sector wage and salary workers participating in employee-based retirement plans. And these are the years. So going back to 1980 up until around 2015, and even into 2020, you'll see that this blue line represents, for many years, workers could rely on defined benefit pension plans that paid a set amount in retirement. So these are plans that companies contributed to the employee on the employer contributed for the employee on their behalf, and they did not contribute it. But as you can see, there was about 28% and back in the 80s, and now going forward, you can see this line dropping. So it's less than 5% of companies that offer defined benefit plans that they contribute on the employee's behalf. Now, you'll see this red line back in the 80s, about 5%. This represents defined contribution plans. So in the last few decades, pensions have primarily shifted to defined contribution plans. So examples of defined contribution plans are 401ks, plans, 403bs, 457 plans, where you're contributing to the plans. These plans require the employee to make investment decisions and build their own nest egg, right? So as you can see, this line has just been going up. So about 35% of companies require employees to contribute to their own plans. Now, this light gray line shows that about 10%, this is a combination of both defined benefit and defined contribution plan. So as you can see, this gap is huge, and more companies are expecting us to contribute and create our own wealth for the future, i.e. for retirement. Okay. So the money talk taboo. To build financial literacy, individuals would benefit from talking openly about money, right? 44% of Americans surveyed would rather talk about religion, death, or politics than discuss personal finances with a loved one. There's fears of embarrassment and conflict are a major emotional roadblock that hampers financial progress. Financial education has not kept pace with the rising need for knowledge. Fewer than half of U.S. states require high school students to take a course in personal finances. Now, I know personally, when I was in high school, personal financial course wasn't even offered. So we have to educate our young adults in this regard. So how do we build resistancy, right? People can follow a step-by-step strategy to help optimize their financial situation. So number one, what you need to do is assess your current situation, your current financial picture. So uncertainty can be a major source of anxiety. When you don't know, you're worried and you're concerned. So to determine the source of stress and if it's warranted, investors can take stock of their own income. So analyzing what income is coming to your household and what expenses are going out. So when you look at these two things, you know what your net cash flow is. If you have a positive cash flow at the end of the month or a negative cash flow, right? There's a surplus or a deficit. And you can do this either on an Excel spreadsheet, or you can simply do it. There's apps out there that you can actually track your income and expenses. Even banks have apps where you can actually download your monthly statement and find out and figure out what income is coming in and what expenses are going out. Savings, knowing how much you're contributing to savings. Savings is going to be key. With your income, you need to take your money right off the top and pay yourself back. Because if you don't do that systematically and automatically on a month-to-month basis or as you are paid, more than likely savings will not occur. I usually recommend to start out at least with a minimum of 5 to 10% and increase that percentage as your salary increases, as you get raises. Now, debt management is also going to be key. Looking at what debt you have outstanding, looking at the interest rate that's being charged, try to eliminate or minimize those things with high interest rate. So, because at the end of the day, you're paying more in interest oftentimes than it takes to get that debt down. So, financial self awareness is positively associated with greater financial satisfaction and stronger spending and investment decisions. So, when you take control of these things, you're able to understand where you are. So, looking at your current picture now and looking to where you want to go in the future. So, step number two with building resistancy, prepare for the worst case scenario. If an individual loses their job or saw a prolonged drop in their retirement savings, what could they do? So, investors can consider various options, right? They can increase their retirement plan contributions. They can apply for government benefits, such as unemployment. If you're eligible for Social Security, you can apply for that. Cutting unnecessary expenses. In this pandemic, we're really realizing how much money that we can actually save from gas, not having to drive into work, not having to go and get our hair done, our nails done, and things of that nature, or even buying coffee. Starbucks, I call it $5. You spend at least a minimum of $5 when you go into Starbucks. So that's $25 a week if you did that 5 days a week. And if you multiply that times 4 weeks in a month, that's $100 a month that you can save right there. And then also another way you can do is to increase your income is taking on freelance work, right? So you may have your regular 9 to 5, but take on something that you enjoy, something that you can actually get compensated for, and that could be your 5 to 9. Then you can take a stress test regarding your financial plan to account for these scenarios and begin preparing as best as you can. All right. Number three in our building resistancy is break goals into small chunks. This helps ensure that they are specific, achievable, and measurable. So, by setting smaller goals, investors can take action to make progress. Research has shown that achieving quick wins makes people more likely to achieve their financial goals. So, this is an example. If you have a large goal to pay down like $51,000 of debt, and you want to do this over a 5-year plan. So, your incremental goal may be to make $850 monthly payments over 5 years. So in year one, your $51,000 debt has now decreased to $40,800. And again, this doesn't assume interest rate, but this is strictly, paying down the principal. In year two, that debt would have decreased to $30,600. Year three, $20,400. Year four, $10,200. And then by year five, you've paid that debt off. So do it in small chunks where you can see the progress. All right. Step 4 in our building resiliency is to improve financial knowledge and openness. Investors can educate themselves as much as possible. So, the ability to talk about money is one of the most important skills for building financial literacy. So, people can also take steps to break financial taboos with loved ones, right? So, number one, start with simple conversations about experience or advice. Number two, build to more concrete discussions about family finances. Number three, ask questions about goals and contingency plans if something were to happen to you. Number four, consider seeking advice from a financial professional, right? So that knowledge gap. So this chart here shows the white is a high level of knowledge, and then the red is a low investment knowledge. So we found that individuals with high investment knowledge are more prepared and less anxious. So has planned for retirement, 73% has a high investment knowledge, whereas 63% have a low investment knowledge. So next example is feels anxious when thinking about personal finances. 21% that have that high knowledge, they feel less anxious when thinking about personal finances. 48% have low investment knowledge and they feel more anxious. And then last but not least, those that have emergency savings, 90% have high investment knowledge, whereas 78% have low investment knowledge. So you can see the correlation with, having these things and having the knowledge and building on that to lower your anxiety and this can impact your health. All right. Step number 5 in our building resiliency, create long-term purposeful goals, right? Setting the right goals helps investors define their own parameters for success, which in turn keeps them focused and motivated. To achieve these longer-term goals, investors may consider vehicles that historically provide better returns over time. So it's also important to monitor goal progress regularly to allow for portfolio or contribution adjustments as needed. So this is just a hypothetical chart. This shows asset class return percentages, the highs and the lows from 2000 to 2019. So equities have previously demonstrated that higher potential returns than fixed income. And this is basically showing the high. And these, again, these are small companies, small stocks, where the high was about 57.2%. This is relating to the returns. The low was a negative 33.79%, and then the average is right around 7.59%. So this is 20-year annualized return. All right. So for large stocks, and I'll define those a little bit later, 33.11% was the high, and the low was negative 37.6%. Average rate of return was about 6.29. So as you get more conservative, so corporate bonds are more conservative, the rates of return was about 23.89%. That's the high. The low was a negative 7.24. And then the average rate of return was about 7.68. Now let's look at alternative investments. The high rate of return was 19.98. The low was negative 19.03. And then the average was 5.22. Then last but not least, treasuries. The high was 13.79 and the low was negative 3.56. Average rate of return for treasuries, 4.63. So there is no guarantee. Past performance is no guarantee of future results. And as we all know, an investment cannot be made directly into an index, but this is just showing you some examples over almost 20-year time span. All right. So financial crisis can strike at any time, as we have seen with the pandemic. So to improve your financial situation, you can focus on controllable elements of financial health. So if you think about, when it's raining, you go out and you have an umbrella to protect you, right? So this allows investors to emerge with a stronger, more resilient plan than they had before the crisis. So again, we talked about this before, spending less, saving more, borrowing less, and planning, having a plan in place. So again, people don't plan to fail, they just fail to plan. So as I mentioned to you before, in terms of small stocks, these are measured by approximately 2,000 of the smallest American companies in the Russell 3000 index. Large companies are those stocks with 1,000 stocks in the Russell 3000 index and represents about 92% of the U.S. market. Corporate bonds are represented by the Bloomberg Barclay, which are corporate bonds, and they are their measurements of investment grade, fixed rate, taxable corporate bond market. It includes US denominated securities publicly issued by the US and non-US industrial utilities and financial issuers. Alternatives, these are over 2,000 hedge funds that represent at least 50 million under management or have been actively traded for at least 12 months. There are no fund or funds included in this index. Treasuries are basically they're indexes based on public obligations of the US Treasury that have remained maturities of more than 1 year. So that's just some definitions for you. As you know, all investments are subject to market risks. They include possible loss of principal. Diversification can't assure a profit or protection against loss in a declining market, but not having all of your eggs in one basket is important. So with that, this is the bulk of the presentation. What I do want to focus on, if you can see this, just talking a little bit about taxes. If you would look at this chart and how taxes will affect your portfolio, you should think about that, because taxes, so growth or gains of your assets really fall into three income tax categories. So assets put money into your pocket, whereas liabilities takes money out of your pocket. So with these three tax buckets, the first being things that are taxable now, the second or the middle bucket are things that are taxable later, and then the last bucket is things that are tax-free. If I don't tell you any more about taxes, where would you want most of your money to be? So on this next slide, I just want to share with you how and what types of assets fall into these particular buckets. So where are your assets now? So that, again, that first taxable bucket, the purple one, this is examples of things that are taxed now. So you would receive a 1099 from the IRS and you would pay taxes on that currently when you pay your income taxes. So examples of those are your savings and your CDs, your investment accounts, real estate, business income, and just your wages. So when you earn this income, you report that income currently and you pay the taxes on it now. This middle bucket, or our tax deferred bucket, individuals will receive a 1099 later when they actually receive the money. So examples of our tax deferred are 401ks, 403b plans, 457 plans, IRAs, annuities, other types of deferred compensation plans. The monies are placed in these tax buckets on a pre-tax basis. When the money comes out in the future, the money's gross tax deferred, and when they come out in the future, you pay taxes on that money based on your current income tax bracket. Now, for those under 59 and a half, be careful pulling monies out of these types of account, because you would be taxed at ordinary income taxes plus a 10% early withdrawal penalty. Now, this last bucket, or the green money bucket, is our tax-free or tax never bucket. So examples of our tax-free distributions are Roth accounts such as 401ks. You can actually have a Roth 401k or a Roth IRA. 529 plans. So these are college savings plans. You put monies into these type of account on an after-tax basis, and then the money's all future growth and the distributions come out tax-free. Municipal bonds is another example of things that are tax never. And then last but not least, cash value on life insurance policies. Those are permanent life insurance policies where you, as long as you follow IRS rules and you don't do things that cause it to be a taxable event, those come out tax-free as well. So where are your taxes now? Look at these and figure out, are you happy with these percentages, or would you like to discuss redistributing some of your assets into maybe this last bucket or this tax never bucket? So let's take a quick peek at where do you think tax rates are going. So this orange colored is the highest tax bracket, and this goes back to 1933, believe it or not, to roughly about 2018. highest tax brackets, believe it or not, back in the 1940s was as high as 90%. And the blue represents the lowest tax bracket, right? So taxes were as low as 5%. And right now, if you look at fast forward, we're actually in a low tax environment right now. So highest tax rates being under like about 37%, and then low tax brackets is about 10%. So where do you think tax rates are going, being that we are in a low tax environment, right? The fact of the matter is that we're in a pandemic and we have put a lot of money into the economy. Where do you think tax rates are going to go? Who's going to help to pay the deficit that we're in? More than likely us as taxpayers. So, although we can't predict the future on, with the tax rates, we know that there are two things that are certain in life, and those are death and taxes. So, just be cognizant of where tax rates are going and how your money is distributed, as we talked about in this tax bracket, these tax buckets. Because if you have a lot of money in tax deferred and you're thinking in the future, when I pull these monies out, I'll be in a low tax bracket, so I'll be paying less tax rates. Well, if we don't know where tax rates are going and they in fact go up, that your thought process may not be accurate. All right. So I believe I've covered all that I wanted to cover today. I don't know if there's questions, Dana, but where do you go from here? I know we talked a lot about a lot of different things, and where do you go from here, right? Do you do it yourself? Do you, look at these things and try to figure out what's the best way to go? Or do you get professional assistance, a team of professionals that you can trust, that you can ask questions regarding your goals, your time horizon, and they can actually help you crystallize your goals and objective and help you sort out your choices. So you can get answers to questions that are big or small, and you can come up with a plan that evolves as your life does. So I'd like to thank you, Dana, for giving me this opportunity. I'm sharing with you my contact information, in case you have any questions. You can feel free to reach me via cell. My cell phone is 732-309-3305, or you can reach me via email at thaskins@nyl.com, or feel free to visit my website. It's www.tamara.nylagents.com. Thanks again. And just so you know, although I'm a CPA by profession, neither New York Life nor its agents provides tax or legal or accounting advice. So you will have to consult your own tax, legal, or accounting professional before you make any decisions. Thanks again.
Oh, I guess that would be helpful, right? Just the look of technology. Well, thank you again for coming on and providing us with such wonderful knowledge around our finances, our budgeting plan, and all the different things and aspects that come around with that, which includes saving and, more importantly, taxes. You can definitely not escape the tax man. So it's important to either get ahead or just make sure you're consistent in staying on top of that. So thank you so much for joining us today on the Presented Series.
Thank you. I appreciate it.
Absolutely. Absolutely. So please continue to tune in. We actually have another Represented Series up tomorrow, same time, same place. So thank you again for coming on, and we look forward to seeing everyone soon.
Thank you.
Thank you.